Hi everybody. Today we're going to cover the study note 104/15, and we're going to be focused on just the first three sections of chapter 12 of Imagine. And so this section goes over in more detail from the fund's point of view of when you're investing retirement funds. And we're going to be focusing a lot more on return calculations in this section here of the performance evaluation area. So first off, when you think about performance evaluation, you think about what it is and why do you even need to do that. And it makes sense if you think of it from two perspectives. So the first is the fund sponsor, and that is the basically underlying company that's investing in this fund, and who you can think of them as the pension funds or the trustees who are asking these investment managers to invest in their money. And they need the performance evaluation because this will enhance the clarity and transparency for the underlying investments, and it will help the feedback loop as well, as they can see, okay, well, my fund is performing well or not well this period. And from the investment manager's perspective, these are the guys that are actually investing the money. This will give them a clear communication channel to communicate the fund results to the fund sponsor. And it will also help the fund sponsor understand what investment strategies they're doing and how they're performing over time. And basically, this entire chapter 12 of Imagine will cover performance evaluation. And under performance evaluation, think of it as really three main components to it. So the first component, which is what we're going over in this video, is performance evaluation. And it answers the question of what was the account's performance over the evaluation period that we're looking at, which could be 1 month or 1 year. And you're going to answer that question with return metrics such as the rate of return, the Sharpe ratio, and there are a lot of other return metrics as well that you could use. The next two components of portfolio evaluation we're going to cover in other videos. So the first one is performance attribution, and that answers the question of what the account produced and why the account produced the observed performance over a certain period of time. And it will basically try to attribute the overall return to different little decisions that the investment manager made over time. And the last bullet point is performance appraisal. And that is answering the question of whether the account's performance was due to luck or skill. So just keep those two additional components of a portfolio evaluation in the back of your mind. And we're going to focus now on measuring performance. So when you first think of measuring performance, the most common thing you'll think about is rate of return, and that looks at the percentage change in the account's market value over a period of time. The key thing to note here when you're looking at the definition of rate of return is that it only focuses on measuring the change in value solely due to investment sources. So whether or not you have a certain amount of money in your pension fund or your account, and let's say you have some mid-year deposits into the fund or mid-year withdrawals, that should not affect the overall return of the portfolio. And when you're looking at returns too, it's important to distinguish between different types of returns. And one thing you'll hear a lot in the in the books and the investment management media is whether or not you're looking at price returns or total rate of returns. And when we're going to be talking about returns in this setting, we're going to be focusing on total rate of return. And this is the increase in the investor's wealth due to both investment income, which you can think of as interest and dividends, and then capital gains, which looks at the gains that you realized from the actual price increase of your underlying investment. And I think the best way to illustrate this is looking at investment in fixed income. So suppose you invested money in a 10-year, 3% coupon treasury bond. Your total rate of return for an evaluation period will be consisting of two components here. So one is the investment income, which is your coupon payments that you're going to be receiving each period. So these are the 3% coupon payments. And the other component, though, is the capital gains part. And that is when your bond's value, the underlying price, will increase or decrease in value based on how the interest rates move over time. So in this case, if interest rates decreased, then the price of the bond would increase, and then you'd also gain a capital gains from that as well. But just remember that total rate of return captures both this investment income portion and the capital gains portion. and then you should be good to remember that. So now when you're looking at return calculations, the book kind of focuses on two main types of cases. And these are basically the two main cases that you want to familiar yourself with when you're going to be asked to calculate rate of returns for the exam. So the first case is a very simple one, and it's the case where there are no inter-period external cash flows. And what I mean by that is basically if you're looking at a period, evaluation period of let's say 1 month, you're not going to have a case where in the middle of the month some external party deposited more money into the fund or withdrew money from the fund. So the money underlying the fund is just constant, and the only changes in the value of the fund is solely due to the performance of the investments. And in this case, you calculate the rate of return by simply looking at the difference between the market values of the fund, and then you divide that difference by the starting market value of the fund. And if you want to see how that would come out in practice, in this example, let's say the starting market value of the fund was $1.15 million, and the ending value of the market fund was $1.25 million. Then in this case, if you look at the previous formula, the effective return over the period would then be the difference between MV1 and MV0, and then you just divide by that starting market value as well. And then you get a return of 8.69% from this example. And also it's important to be precise in terms of what period of return you're looking at here. So if this evaluation period from time 0 to time 1 was 1 month, then this return would be an effectively monthly return, 8.69% over that month. But if you were looking at an annual period, so if this was the market value at the start of the year, and this was the market value at the end of the year, then this return would be an annual return of 8.69%. So it's very important to know when you're looking at returns what time period you're referencing and how to convert between those time periods as well. Now, the second case is a little more complicated. And this is the case where you have inter-period external cash flows. And what you want to familiar yourself with is that there are two methods of calculating returns when you have cash flows occurring within the period of time. And so one is called the time-weighted return, and the other is called the money-weighted return. And this table here kind of just goes over a brief summary of the differences between the two. So time-weighted return is basically you're just looking at the growth of a single unit of money, like $1 invested in the account. And when you're looking at the time-weighted return, based on how you calculate the return, it ends up being unaffected by the size and timing of the external cash flows. And as a result, that has made it become a standard measurement of return in the investment community, because it's widely accepted that in general, a lot of companies can't really control when someone wants to withdraw or deposit money, and that shouldn't skew the return performances one way or another. Money-weighted return, on the other hand, it represents the average growth rate of all the money invested in the account, and that includes when you have inter-period deposits or withdrawals. So as a result, this does make the money-weighted return, which I'll call MWR here, sensitive to the size and timing of external cash flows. And it can then be thought of as an internal rate of return. So if you remember those IRR calculations, it simply will be kind of the underlying rate of return that gets your starting market value with those middle intermediate cash flows, and it gets you to that ending market value that you want. So it might be a little confusing just looking at these bullet points first, but once we go through a couple examples, hopefully this will be more clear. So for the time-weighted return calculation, the typical example you'll see in an exam is one like this, where you're going to have, in this example, our evaluation period is 1 month, and you're going to be provided the end-of-day account values for specific days. And in this example, our starting account value is going to be $1 million, and our ending account value at the end of the month is $1.08 million. What's a little more complicated now in this return measurement is you're going to have days 5 and day 16 here will have intermediate contributions of $30,000 and $20,000 in cash flows. So this could be maybe because you receive more premium from underlying retirement beneficiaries. Now, Under a time, and this is a very key thing to remember here, under a time-weighted return calculation, you will also need to know the end-of-day account values during those days in which a cash flow occurred. So we will need to revalue the account and figure out what the market value is at the end of day 5 and the end of day 16. And so here, let's just assume that those numbers were provided for us, and we have it as 1.045 million and then 1.06 million dollars here. And this 1.045 is basically including this $30,000 that was input in cash, and the same applies to the 1.06 million. Now, if you're going to be asked to calculate the time-weighted return over this month, you're thinking, what am I going to do here? Well, the first step is to always divide the evaluation period, which is 1 month in this case, into sub-periods. And the sub-periods will be dictated by when the intermediate cash flows occurred. So since we had 2 cash flows at day 5 and day 16, our sub-period will be divided based on the period when we had no cash flows occur. So sub-period 1 will be days 1 through 5, sub-period 2 will be days 6 through 16, and then sub-period 3 will be days 17 through 30. Now, the next step is to calculate what those returns were in the fund for each of those sub-periods. So if we go back to this slide right here, what would the return be for the fund on sub-period 1? Well, based on the previous example that we did on calculating the market value and calculating rate of returns, you could take the difference between the end of day account value and the beginning of day account value, and then divide it by the beginning to get your return over days 1 through day 5. And that is basically accurate, and the only one additional step is you're going to have to subtract this $30,000 from this 1.045 end of day account value here, because this $30,000 shouldn't be at all contributing to what the performance was for that time period. And the same applies for when you're calculating the sub-period returns for days 6 through 16 and days 17 through 30. So, in this case, for sub-period 1, your return would be that 1.045 ending day account value minus the contribution that you made on day 5, and then subtract that starting market value, and then you end up with 1.5% or 0.015. And the same thing applies for sub-period 2 as well. You'll start off with, you take the difference between the ending market value on the end of the second sub-period and subtract that contribution of $20,000 that you made, and then note that the starting market value now is going to be 1.045 million for sub-period 2, because we're now looking at the period from day 16 to day 16. I'm sorry, day 6 to day 16. And that would give you a market value return of negative 0.48% over that period. And you do the same thing for sub-period 3, and then you get 1.89% for that sub-period. But just remember, the key thing here is, again, you have to, in order to do these sub-period return calculations, you have to know what the market value of the account was every time a contribution was made or withdrawal was made. And now, once you have these sub-period returns, to calculate the return over this entire time period, you simply will do something that's called chain linking. Chain link these returns and then subtract 1 to get that final return over the evaluation period. So what you do there is you would basically, you're taking the 1, you would basically add 0.015 to 1, subtract the second sub-period returns from 1, and then add the third sub-period return to 1, and then subtract 1 finally from this entire chain right here. And if you do that with the math, you'll end up getting 0.0292 or 2.92% here. So this is a chain linking part that you'll see a lot whenever you're doing return calculations over periods of time where you're connecting sub-period returns. So this is basically the final time-weighted return calculation that you will have. And just another side note here to take a note is that each sub-period return receives a weight proportional to the length of the sub-period. And that's important here. So if you had a sub-period that was only 1 or 2 days, for example, and let's say during that sub-period the return was very high, that's not going to really matter too much though, because the weight's going to be proportional to the length of the subperiod. Now, for the money-weighted return calculation, it's going to be a very similar setup in the previous example, and I have the same numbers here. But the difference is we're not going to need the account value at day 15 or day 16, which is when the contributions occurred. So, in contrast to the TWR approach, for the money-weighted return calculation, we don't need to revalue the account whenever an external cash flow occurs. And if an exam question asks you to compare money-weighted return and time-weighted return, this is one important thing to remember. Because under money-weighted return calculation, if you want to calculate the NWR for this period of time, the way you would set up this problem is you would solve an equation for the rate of return. And this equation would be set up like this. So 1.08 here would be the ending account value. And then you'd basically apply that money-weighted return that you're trying to solve for to each of these cash flows here and the starting market value. And the only difference is the exponent here. This represents the amount of days, or in other times it could be months, that the cash flow would receive that return. So because your starting account value of $1 million is going to be subject to that return performance over the entire period, you'll apply 30 days of this return to this value right here. Now, the $30,000 right here receives an exponent of 25, and that's because this $30,000 cash flow occurs in day 5. So it will receive the account's performance for another 25 days, from day 30 to day 5. And this $20,000 cash flow receive performance for another 14 days, as that will be the remaining time of the month at that time period. So that's where you're basically getting these exponents here of 25 and 14. And this is going back to the point how this money-weighted return calculation is applied to the average amount of money in the fund over the evaluation period. Now, when you're looking at this equation, you're going to be like, how am I going to solve for MWR here? Because I can't do it by hand. And yes, this is basically very similar to those annuity problems that you ran into in exam FM, where you're trying to solve for that rate. And whenever you do that, you can't really, you need a calculator to solve for it. So once you enter it in the calculator, the solution here is going to be 0.095%, and this number here is going to be a daily return just because of the way we set up this problem. So if the question is going to be asking for a monthly or annual type of return, you'll have to do the appropriate conversions. So for this case, the monthly MWR would simply be, you simply add 1 to this daily return and then take it to the 30th power, which represents the number of days in the month, and subtract 1 to get 2.9%, which is very similar to the time-weighted return calculation that you saw in the previous slide. So in general, there's not going to be too big of a difference between the money-weighted return and the time-weighted return calculations for a similar portfolio, but there will be cases when they could be different. So yeah, just as a summary here, for this money-weighted return calculation, you will need a calculator or software to solve for MWR. And when you're doing these calculations, sometimes you might get 2 solutions when solving for this IRR. So just remember to always take the positive solution, because that is, that is the solution that you would want here. Now, this slide here covers when money-weighted return and time-weighted return will likely differ. And this is an important thing to remember, because you can anticipate maybe an exam question asking you to calculate the money-weighted return and time-weighted returns, and then figure out, when would they actually be different from each other. So the key thing to hear is they're going to be very different when you either have a large external cash flows and when the account's performance fluctuates significantly over the time period when that large cash flow occurs. So let's say, for example, in this case, in this previous example, that for the time period of day 5 to day 16, you had $30,000 inputted into the account. And let's say after that, day 5, the account performed really, really, really well over that time period. Well, the money weighted return calculation, because of the way it's set up, that $30,000 will be subject to that strong performance over the next 15 days. So that will bias the money weighted return calculation higher. It would make the ultimate return calculation you get higher. Whereas time weighted return is not affected by these external cash flows that occur. So when this happens, when you have contributions to the fund before a period of strong performance, MWR would then be positively affected relative to the time weighted return. So it'll be a little bit higher. And conversely, if you have withdrawals occurring before a period of strong performance, the money weighted return will be negatively affected relative to time weighted return due to the similar reasoning there. Now, and linked IRR now is one other return method that you should be familiar with. This one's not going to be as common as the time weighted return and money weighted return. But the point of linked IRR here is basically is a combination of money weighted return and time weighted return. And the reason why it was proposed is because a disadvantage of time weighted return is it requires account valuation on every date that a cash flow takes place. So linked IRR, what you can do is you can avoid this problem by simply calculating the money weighted return over short time period intervals, and then you would chain link these returns, which is the attribute of time weighted returns, over a specific time period. And then by combining both of these attributes, you're basically looking at the strengths of both MWR and TWR and discarding their weaknesses. So a quick calculation example here. Let's say that we've already calculated our money weighted returns here, and our evaluation period is 1 month. And so let's say we already given a problem where the money weighted return calculation for weeks 1 through 4 were these numbers right here. Now, if someone asks you to calculate the linked IRR for the month, what you would do then is you would take these these MWRs here, and then you would link them together in a chain linking fashion, just like you did for the time weighted return calculation. So as you can see, I'm simply chain linking each week's return with each other, and then finally subtracting one from the result to get negative 0.018%. And it's once again a simple calculation here. It's just you're mixing both the money weighted return calculations that you're doing within each week, and then the chain linking part is what you're taking from the time weighted return calculation. So, and that gives us once again a result of negative 0.018%. And LRR can be a good approximation under most scenarios, but just remember it can be inaccurate though if you have large external cash flows and volatile swings performance. And that's the reference again back to when you have situations where the money weighted return is different from the time weighted return. Now finally, when you're looking at annualized rates of returns, one thing to note that in our previous examples is all our reference time period was monthly. So we're looking at monthly time periods. And a lot of times the managers will want returns to be expressed in an annualized form. So what that means is you're going to also typically do geometric means of the returns earned over evaluation period. So one example of a case where you would maybe need to do some calculations for this is if you're getting a rate of return series for a series of years. So for example, let's say year 1 was 3% annual return. Year 2, before the return was 5%. Year 3 return was negative 2%, and so on. If you were asked to calculate what the effective annual rate of return was over a 5-year period, what you do is you simply do the chain linking again. And here I'm chain linking these 5 returns, and then I will be taking an exponent to the 1/5 power since there's 5 years here, and then subtracting 1. And then as a result, I'll end up getting an effective annual return over this 5-year period of 2.12%. But the key attribute here is this chain linking of these returns is equivalent to a geometric mean of the returns earned over the evaluation period. And this will give you accurate output is if I returned if I had a portfolio that returned 2.12% every year for 5 years, it would give me to the same ending value as if I had a portfolio that earned these 5 returns each year. And so just remember this annualized return calculation and how to express portfolio measurements in an annualized basis. Now, the final thing to remember about performance measurement is data quality, and the book had a couple pages on this I thought would be worth noting. So you won't always have a case where it's easy to evaluate the market value of the account at any point in time. And this will be the case when you have accounts invested in illiquid and infrequently priced assets. So one example that you can think of is venture capital funds, and for those cases, it's not really easy to sell the underlying equity in the venture capital fund. So a lot of times, the solution that you can get through here to remember is called matrix pricing, and that's when you're estimating the prices of illiquid securities based on market prices for similar securities that are more liquid. So, for example, if my account was invested in a very illiquid tech stock, and I needed to get a market value for that illiquid security, what I could do is I could try to look up a similar security, maybe like Intel or IBM, and that price could be used as a proxy. I don't want to be worried too much about number calculations for this. Just be more familiar with potential issues for data quality if you were asked upon that on the exam. And so now that kind of just summarizes the performance measurement, at least, and just the key takeaways you could have for this slide is just remember return calculations for performance evaluation and how to go about that. We'll go over the calculations for time weighted return, money weighted return, and linked IRR. And finally, the SOA loves to ask you questions comparing the two, and so being able to understand when the two would be different and comparing why time-weighted return or money-weighted return would be different from each other is another key part of this as well. All right, and that will conclude performance measurement.